certified financial planner and co-host of Your Life Simplified.
How you doing, Valerie?
I'm good. I hear you do not live in a cave.
I don't.
Is that correct? That's great. So you've heard about the bonds that have been the news lately about bonds.
Yes. Yeah. I mean, I feel like it's just about everything right now. But yes, they're still boring, but it seems like they suck now too. So that's like it's like everything bad.
Everything bad is there, which coincidentally made me think about your girlfriends. I hear, so go with me on this.
Okay, I'm with
I hear you're dating a nice girl.
She's
right?
great.
Samantha.
Yes,
she's
that's
good.
her name. That's her name. Yep.
Samantha, last name Old Bond. And Samantha, from what I hear, she's a real steady, 10-year relationship kind of girl that
she's got
works
some
for the
stability.
U.S. Treasury.
Yeah, she's got some stability.
Okay,
sure.
Perfect. So nothing that's too crazy or surprising.
Nope.
That's Samantha. But I heard that, when you went to the gym the other day and in walked a new girl, Monique Newbond. And I can tell you remember Monique. What was it about Monique that was so interesting?
I hope Samantha's not listening to this. I would say the unpredictability.
Oh, okay. So excitement.
Yeah.
And that she's got a really great interest rate, right?
Yes.
So
not that I would be interested in her because I'm taken right now and I have a girlfriend. She's wonderful. But if I were,
higher interest rates are attractive, right? And so
yes.
that's really what we're talking about today. We are seeing a ton of volatility in the bond market, and it's largely based on the fact that new, real sexy, interesting bonds are coming out with higher interest rates.
Yep.
And they are competing with the existing bonds that have a lower interest rate. And it's just causing a lot of chaos as we are seeing. And so really what I wanted to do is let's back up, right? Let's look at how do bonds work? What Bond 101, just give me the down and dirty on that, if you wouldn't mind.
Yeah. Well, we talk about interest, and I actually have a question that has to do with relationships for you as well, if that's okay. And I think a lot of people can relate to this, but have you ever met someone that you just couldn't figure out?
Oh, I think I married him actually. Yeah.
So, maybe not the person that you married in this case, but there's something that maybe, I think we can all relate to maybe that one person that we maybe knew in our life from a relationship stance that for whatever reason you knew maybe wasn't great for you. But there was some there was some dopamine rush of unpredictability there. And I think there's nothing quite like that, even if it maybe isn't what's best for you, right? So when we're talking about bonds, there's nothing exciting about predictability. There's nothing exciting about that, okay? They're literally trying to tell you from the get-go, here's what you should expect. So we think about how a bond works. You have a stated interest that you're going to be getting from that bond. At the end of it, if you were to buy the individual bond, I know a lot of people buy bond funds now, but at the end of it, the maturity, as they call it, you would get your principal back. So there's nothing really exciting about predictability. And with all of these interest rate hikes that we're having right now, Valerie, and the expected interest rate hikes, people are starting to wonder, okay, well, should I even be investing in these things? Because the whole reason why I did it was the stability, but is the return that I'm getting from this worth that stability if it's not giving me much of a return? And I think that's the big question a lot of people have today, Valerie.
Oh, absolutely. Right. Going back to that initial example that was completely fabricated, Samantha, I promise. When we have our 10-year bond that pays 0.5%, let's just say fictionally it's $100, right? For that thing.
Yeah.
Well, we get a new bond that comes out and it's a 10-year bond, but it's paying 3%. Well, guess what? Nobody wants to buy that original bond that's paying 0.5% at $100. So that original bond's dropping in price, and the new bond, that's where it's at. That's where that weird inverse relationship with bonds come. The higher the interest rate, the higher the prevailing interest rate, the lower the prices of the existing bonds come up. And so, it's been such a long time since we've been able to actually live off of bond interest rates. Maybe back in the 80s, you can say, yeah, my bond portfolio pays me enough that I can actually, pay my rent and eat at the same time. But we haven't had that in such a long time. And so, yeah, the unpredictability of shifting into what that is. My existing bonds are dropping in prices like crazy. Should I even be buying into new bonds because the interest rate's going up? What if it continues to go up? What if there's somebody else even more exciting than Monica or Monique or whoever it is? What do we do? And so that is
Some new
absolutely
bond
the
is
environment.
formed.
Yes, exactly. So that's the environment that we're trying to figure out right now. And so some clients, and we're hearing a lot of this, is they're saying, forget it. I don't want to even talk about bonds anymore. What else is there? So we gotta address that, right? What else is there?
Yeah. I think, understanding really why you even have a bond allocation is something that people skip over a lot of times. Like, what is the framework that exists there as to why, somebody who's retired, the 60/40 portfolio that we have, right, that floats around, why is it that there's 40% in bonds? I think it's important just to understand first, why that is before we get into the alternatives and really how it came to form, right? So, 1952, a ways back, still there were some bonds out there. Harry Markowitz published Modern Portfolio Theory. He's a Nobel Peace winning economist. And really what Modern Portfolio Theory said is we are going to create an efficient frontier, a formulaic weighting of portfolio assets to give people a framework for how they should invest, right? So they should have about this much in bonds and about this much in stocks if they want to take on X amount of risk, right? So depending on how much risk they want to take on, there was a weighting that was there, okay? That's still, I think, fairly present today as far as how a lot of investors, investment representatives choose to invest people's money. They follow this framework, this modern portfolio theory. The problem is, in 1952, was it more or less complex than it is today? The investment world, were there more or less options today, Valerie, in comparison to 1952? Obviously, there's a lot more options today. Primarily in 1952, people were actually going and buying paper bonds where they'd have the little coupon, and they'd go to the bank, and that's why they're called coupon payments. They'd get their coupon, their interest back, each month or every 6 months, depending on the bond, right? So it was primarily just stocks and bonds. Today, we have a much more intricate, complex investing world. So the question is, okay, not only are there more investment options, but there's also these other assumptions that don't really seem to work out with modern portfolio theory, like the fact that it was almost entirely based on history up to 1952. And well, things have changed a little bit since 1952. Should I be considering any alternatives? So that's kind of the framework as to why this is really questioned now. Like, hey, should I just have a 60/40 portfolio? Modern portfolio theory, there's some tests that it seems to fail. And because of that, people are saying, okay, maybe the 40% in my 60/40 portfolio isn't just bonds, it's other alternatives or other asset classes in addition to, maybe 20% bonds or 30% bonds, right? And obviously there's not a direct recommendation here. So I'm going to go through some of these alternatives. And Valerie, if you would, feel free to jump in on any of these or add any that, might come to mind, because there's an infinite amount here we could talk about. But some of the popular bond alternatives that people seem to look to, I'd say one of the first is real estate. And, it's not that people in 1952 didn't own real estate. It's just there are new ways to invest in real estate that wasn't really paramount back then, right? So real estate investment trusts, for example, you can purchase securities, both private and non-private, however you want to go about this, that allow you to diversify across a number of different real estate holdings. And some people might look at that and say, okay, well, the return that's coming from that is a lot better than my bonds. And there seems to be less standard deviation, less up and down than stocks. So maybe that's a good bond alternative. I think for any of these alternatives, as we go through them, understand that I'm not saying it's a one-to-one alternative or replacement for bonds. It's the question of, okay, would a combination of these other assets make sense? That's absolutely the case here with real estate. It is not a one-to-one replacement for bonds because it has a lot more variance in its returns, a lot more standard deviation than bonds. Now, it has a lot more return, but again, the up and down is certainly quite a bit more than bonds. So it's not a direct replacement. And again, as I go through these, understand that the question is much more, how do I combine these different risky assets to maybe form somewhat of a quasi bond alternative package in addition to the bonds that I have, right? So, I would say that's one of the first ones, Valerie.
Yeah. And I would add with that piece too, is that, with bonds, people traditionally think of the income that they get paid, right? Those cube,
Right.
like you said. And so with
That's a
real
good point.
estate, if there's rent and that's usually the case, then we're also looking at like another stream of income that can kind of supplement or replace bonds. We'll get to that thought a little bit later too, but it's just something to note there.
You're exactly right. So the higher yields maybe yield people thinking this is like a bond, because a lot of REITs have higher yields, but also, they have income in the form, if you hold it privately, of just the rent that you're collecting, right? So it's a great point. I would say preferred shares are another alternative people think of a lot of times. In a lot of ways, and people might not be fully aware of like how preferred shares work, but in a lot of ways, they are kind of like a stock in a bond. You have higher yields, certainly less appreciation than, let's say, growth stocks. But again, if we're going to compare this directly to bonds, and this is the case for almost all of these alternatives, there's more standard deviation, there's more up and down with preferred shares than you would find with bonds. Okay. So I don't see this as a direct replacement, but it might be something that you combine into, again, if we're breaking down the sleeves of your allocation, you have stocks, you have bonds, and then you kind of have this this quasi bond alternative, if you will, of the modern day. Preferred shares might be something that you look at because you're going to maybe get a little bit more interest, a little bit more stability than a growth stock, traditionally speaking, right? So in comparison, historically speaking. So I'd say preferred shares might be another option for somebody.
Yep.
Another couple alternatives here. I won't dive too much into this one specifically, but commodities seem to come up for a lot of people. The number one commodity that seems to come to mind is the shiniest, and that's gold. And people look at gold as a bond alternative because of what it's done in down markets or recessions. I actually created a video talking about just gold as a direct inflation hedge and how it kind of fails that test as a direct inflation hedge. Again, I really look at this as its own asset class. Very similar here, not a direct replacement to bonds, but something that can maybe generate some return. Now, again, commodities is a broad range of assets too. I think that's important to note. You have gold, but you also have a lot of other commodities that maybe haven't performed to the point where you'd say, yeah, I just want to own a commodity fund. Like if you actually look into what commodities have returned, you might not be as excited to invest, widely speaking, over a bunch of commodities and say, yeah, this is my bond alternative for the long haul.
Right.
But
and let me add too, and I'm sure the podcast that you talked about with gold will dive really deep because that is such a broad conversation. But I think one of the most common points that is brought up is that, bond is a physical, tangible thing like real estate. It brings comfort to people to have this thing. But when you start to really look into it, I mean, bonds themselves, there is no coupon. Gold. Gold bullion cube. It's not going to have a business model around it that's going to yield anything. So it is something that I think on its surface is so shiny and attractive, but there is just so many different things.
The really intrinsic value maybe isn't there, right? In the same form, whereas debt you can understand, which the history of that is interesting of itself, but you can see a little bit more how debt is going to maybe help fund some venture for a company, and this is coming directly from a company. It's not to say that, again, bonds don't
Yep.
have their risks. It's just that, yeah, that comparison is often made between the two, the intrinsic value, if you will. But another one that comes up, I would say, is infrastructure, especially with this massive infrastructure bill that came through. Infrastructure is a relatively new asset class, but where infrastructure really gained momentum, and this is kind of unfortunate for a lot of investors, is after it did well. It seems to be the case a lot of times, right? So
Right.
bonds are dead right now, but maybe they won't be so dead when these new interest rates that are coming out really start to kick up yields. So theoretically, in the long run, rising interest rates are actually better for bond funds, because that
Mhm.
means the new bond funds, the new bonds that are getting issued, you'll have higher yields. You're not typically buying bonds for their price appreciation. I don't know anybody that's really doing that. But we look at it right now, we say, well, that's down. Plus, I'm not getting much interest. Why would I ever do it? And right now we look at infrastructure and say, well, look at how great it's done over the last year. Why would I not put a bunch of money into that? Again, these
Mhm.
correlations can change quite quickly. We got to make sure we come back to, okay, how does this all come together the most efficient way? Infrastructure is an option, though. It does have, I think, some relatively considerable data that shows, hey, even in recessions, there's contracts that are put in place. There are maybe government contracts that help kind of hold it up a little bit more. And that might be attractive for somebody who's seeking stability.
Mhm.
But this is, again, just maybe one alternative you might have in kind of this quasi bond alt mixture of different assets, right?
Yeah. And
Um,
I think too, just to speak to that understandable, tangible piece, right? It's got that too, because you can say, toll roads can be something that will fit in that infrastructure. And so you
right.
can, think about, okay, people coming by and paying their tolls and,
Yes.
another source of income stream that's understandable. And so I think I agree. I like that as a component as well.
Yeah. And when we think about, from an investment standpoint, government, and not all infrastructure is this way, but, government infrastructure maybe seems a little bit more stability than,
Hmm.
some private investment. Um, Even though that kind of sounds funny saying government has stability. I know people would maybe laugh at that, but from an investment standpoint, that has been the case. So another just, I would say, alternative that's out there is really the insurance realm, right? So there's kind of two different asset classes there. There's annuities and there's life insurance. I'll talk briefly through both. These could both yield their full episode just in themselves, but annuities are a contract that you would get through some insurance company, right? And there's typically some guarantee that comes with an annuity, or at least some, uh, let's just say, hodgepodge of guarantees, just different handful of guarantees that maybe come with annuity. That maybe yields a lot of people thinking, okay, this is a bond alternative. I can get some interest from an insurance company. They insure what I've given them, and in return, they give me income. Or if it's a deferred, let's just say a MIGA of sorts, where you can kind of continually roll over the capital gains going forward.
Hmm.
Some people might look at that as a bond alternative. Again, not a direct one-to-one replacement here because, well, there's some issues on the annuity side, typically liquidity. That's not
Hmm.
always the case. I fully understand that there are annuities that you can have some access or full access, but you're typically giving up some form of return if you're gaining that accessibility. The other side of annuities would be, as far as like one of the downsides, when you're seeking guarantees like this, you're like bonds in a lot of ways, maybe not get the most exciting returns in the long haul. It's not to say they shouldn't be considered, and it's not to say that there's not really a lot of different ways you can build these out, but those in large part I would say would be the considerations that come with annuities. I don't know if you have any thoughts on annuities and life insurance. I was going to touch briefly on life insurance as well, but
Yeah, just
it's the
that,
other one.
like you said, you are paying, it's insurance, right? It's not free. You're paying for insurance for that guarantee. And so there is going to be always that trade off. There is, with everything, there is no magic bullet. There's lots of things that have a really fancy veneer. And I think annuities are
Right.
definitely one of them. Sadly, a lot of the interactions I have with annuities are new clients coming in.
Yeah.
They got into an annuity and they're like, well, what on earth did I buy? It's not what they wanted. So proceed with caution. They have their place for sure, but I think it has to be really well understood and structured correctly.
Yeah, I would say like in the pecking order of like sentiment, like that gets people excited, annuities probably fall below bonds. Like I don't have people coming in like fired up about their annuity. They maybe are this year so far, given what's happened.
Right.
They probably feel pretty good about annuities. I know annuity sales are up in large part. Again, it tends to be the case that people go to these things when bad things are happening, when the asset is doing well, which is actually kind of counterintuitive in the long run of what you would want to do, but people tend to do that.
Right.
The other type of insurance would just be permanent life insurance. This should not be viewed as an investment. First off, that should never be viewed as an investment, but as an investment-like quality in its cash value that maybe can make it appear like a bond alternative if you hold it for the long run. Again, the issues here, you're typically, putting in a fair amount of money into a life insurance contract and you're not breaking even for a number of years. I know there's different ways to structure this to where you can break even earlier, but the trade-off is typically just rate of return, your expected return in the long run. If you're doing this purely as a cash value play, which I hope that people maybe aren't looking to, in the beginning. But I know that there are plenty of insurance sales reps that maybe argue against that. That would be one of the first pieces I'd say. But, some of the benefits here for high income earners, the tax benefits, if you live in a high tax state like California, for example, or Oregon, you get tax-free on the growth, tax deferred as well if you take it in the form of a loan. Again, this should not be thought of as an investment first, but there are some tax benefits there. The other couple ones I just want to touch on just in closing here, there's some laddered option strategies. So I know that we've actually used these and they've certainly worked well here to begin this year, but you can kind of think of it like buffering your returns, if you will. So maybe, you capture, and I'm speaking hypothetically here, you capture only 20% of the loss, right? And it's capped out at that. Or, maybe you don't capture any of the loss up to 10, 15%. So you're buffered for that initial 10 to 15%, but then you can get appreciation up to 15 or 20%, right? So there's some type of laddered strategy that maybe exists there. And again, I know we're not in the business here of making product recommendations in a podcast, so I'm not going to speak specifically to any of them, but I'm just getting into hypothetically how it would be structured. And I think you're familiar with different strategies like that, Valerie.
Yeah, absolutely. There are so many strategies like that. And I think one of the things to keep in mind too is the costs, right? The more complex it is, the more expensive it tends to be. There is quite a bit of volatility that could be involved. And there's just like so many different options. And I think that really does kind of dovetail into the original discussion about bonds, right? Why are we even owning them? And are they dead? Is the intent of why bonds were created? Is that time over? So I wanted to talk a little bit on that. Did you have any other alternative things that you wanted to throw in before I jump?
I would just say, in kind of closing, as far as the alternatives, there's plenty other ones. There's structured notes. There's different ways to do it. But it's a question, as always, of just how does this all come together in the most efficient way for you?
Yeah. And I think with bonds, we talk about, what I like to remind clients is, what was the purpose? Why did we buy them in the first place? They do tend to have an inverse relationship with stocks. Of course, this year, as in the last 12 months, has been a total slap in the face. Like, we got you. It definitely reacted exactly the same way. It's not very common that we have both really high inflation and then, a war with a global pandemic all happening at the same time. So it is a tough environment, that's for sure. But one of the things to remember too is that they do move less they do have less volatility than stocks.
Yeah.
So it can work as a hedge. There is income that is related to them. as we, when you look at it the most simple way, you can say, I bought this thing for $100. I'm going to get it for 10 years. At the end of the 10 years, I'm going to get my $100 back. Even if the going price is $90, I still get my $100 if I let it mature. Plus, I got to flip my coupons all along the way. And so
that's the benefit of the individual bond for sure.
Yep. So just keeping those and really understanding if there is an individual bond portfolio, what that strategy is. And then also, one of the things to look at too is the demand on an existing bond, right? So if everyone's jumping ship and saying, I don't want any of the existing bonds, it only pays 0.5%. Well, let's say that it has a 10% drop in the price. Someone else can say, well, I'm going to buy it and then I'll let it mature. And so now I've recouped my 10%. Plus I got my little bit of coupon along the way. So there is going to still be, activity going on. There's going to be a return for bonds going forward. I don't think the time is dead. If anything, if you have a portfolio that you don't need the cash from, the long haul is still a very viable option. And then with buying new bonds, we will eventually get to a point where people could actually, again, go back to living off of some of that interest and having it be something that's actually worth buying into and saying, okay, I can get a reasonable return from this every 6 months or whatever it is.
Right. Yeah. There's the expectations component too. So it's expected that interest rates will go up. They're going to keep raising interest rates. Sometimes people are like, well, bonds are going to keep just going down because interest rates are going up. That is priced. There is a priced expectation of interest rates going up into the bonds pricing. That's why it's dropped as much as it has. It wasn't a huge shock when the Fed came out and said, yeah, we're going to do 75 basis points. And that's going to be our next raise the past week, right? That was priced into the market from a bond standpoint. And you can watch just days that the Fed announces this and see that it's not, the news of that rate increase that is swaying the bonds because it's typically priced into the expectation. So if anything, it might be a great opportunity because that pricing has already taken effect and now new higher yielding bonds are coming into play. So I think in closing and just in short, if you're at this stage where you're now, okay, do I need other alternatives? Are there other options beyond bonds that really make sense? It's kind of like you just pulled apart the kitchen and you got to do electrical work. You got to do plumbing. You need a freaking plasma cutter to cut the quartz countertops. You might need some help. You might not want to do all of that on your own because there is a lot to this. There is quite a bit to figuring out what do I want to compose of this alternative sleeve, right? What do I want to be full of? What components? So I think just in closing, if you're at that point where you're really considering these alternatives, it's probably worth talking to someone, but understand that there is some serious legitimacy to owning different asset classes than just stocks and bonds as it relates to your portfolio. So hope you guys enjoyed this conversation today. Again, we wanted to touch on just different alternatives because bonds oddly are kind of a pressing conversation for a lot of people. Not always, but typically when they're not doing so well, this seems to come up. Make sure to hit that subscribe button on YouTube, Spotify, Apple Podcasts, wherever it is that you're listening to get more content from industry professionals here at Mariner Wealth Advisors. My name is Michael MacKelvie. I was joined again here by Valerie Escobar, certified financial planner at Mariner Wealth Advisors. You guys take care.
Thanks, everyone.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification. Municipal bonds are debt securities issued by states, cities, counties, and other governmental entities to fund day-to-day obligations and to finance capital projects such as buildings, schools, highways, or sewer systems. Corporate bonds are debt securities issued by corporations. Companies which issue higher yield bonds typically have an increased risk of defaulting on repayments. Investing in any bond is subject to risks, including but not limited to market, interest rate, issuer, credit, inflation, and liquidity risk. The value of most bonds and bond strategies are impacted by changes in interest rates. Bond and bond strategies with longer durations tend to be more sensitive and volatile than those with shorter durations. Bond prices generally fall as interest rates rise, and a low interest rate environment increases this risk. Current reductions in bond counterparty capacity may contribute to decreased market liquidity and increased price volatility. Bond investments may be worth more or less than the original cost if sold prior to maturity. Amortization, accretion of cost basis for a bond held to a maturity will not result in a loss to the client based on the yield locked in at the time of purchase. Income from municipal bonds may be subject to state and local taxes and at times the alternative minimum tax. A strategy concentrating in a single or limited number of states is subject to a greater risk of adverse economic conditions and regulatory changes. Diversification does not insure against loss. Options trading involves a significant degree of risk, and the risk of loss in trading options can be substantial. Clients and prospective clients should carefully consider whether such trading is suitable for them in light of their financial condition and individual risk tolerances. The high degree of leverage that is often obtainable in options trading can work against investors as well as for them. More information on the risk of buying and selling options contracts can be found on the CBOE's website at www.cboe.com.